Hey everyone, welcome back to Corporate Decoder, where we break down the complex world of finance so you don't have to, and today we're diving into A.R.O.W Financial Corporation's latest report. Get ready for some numbers because this one is packed with financial details, maybe a little too packed, and we'll see if that is a good thing or a bad thing. Remember, if you love getting crystal clear insights from these mountain of documents, make sure you subscribe and hit that notification bell. And if you want to chat more about these filings and connect with other finance enthusiasts, join our Discord server linked in the description below. Let's get straight to the heart of it, the consolidated balance sheets. As of the 30th of September 2025, A.R.O.W had total assets of a whopping $4.5 billion. That is a pretty substantial number and represents an increase of about $280 million from the end of 2024. Well, cash and due from banks jumped by over 176%. That is a massive increase in interest. Earning deposits at banks also more than doubled. This suggests they are holding onto a lot more cash or short-term liquid assets right now. On the flip side, they're held to maturity investment securities took a pretty significant dive, losing over 36% of their value. This could mean they sold some or that market conditions drastically affected their value. Overall, though, their loan portfolio remains their biggest asset, standing at $3.4 billion, which is a modest increase from the end of last year. Looking at the liabilities side, their total deposits also saw a nice jump of over 7%, reaching $4.1 billion. This is good news as deposits are generally a stable and cheaper form of funding compared to other borrowings. They did see a decrease in time deposits over $250,000, which might indicate a shift in how larger customers are managing their money. What is interesting is that their borrowings from things like the Federal Home Loan Bank decreased by over 50%. This could mean they are leaning more on their strong deposit base and less on borrowing from other institutions. Now let's talk about profit. For the third quarter of 2025, the company reported a net income of $12.8 million. That is a solid increase from the $9 million they made in the same quarter last year. And for the first 9 months of the year, net income also grew to almost $30 million. Their diluted earnings per share reflect this growth, showing a nice upward trend. Looking at the return on average assets and return on average equity, both are showing positive movement, which is a good sign for their overall profitability. The engine driving a lot of this profit seems to be net interest income. For the third quarter of 2025, it jumped by almost 20% compared to last year. This means the difference between what they earned on loans and investments and what they paid on deposits and other borrowings widened. Their average earning asset yields were up, and importantly, the average cost of their interest bearing liabilities actually went down. This is a sweet spot to be in, where they are earning more on their assets while paying less on their liabilities. That net interest margin ticking up from 2.78% last year to 3.22%. This quarter is a very positive development. Non-interest income also saw a healthy increase of about 7% compared to last year. Things like income from fiduciary activities and net gains on securities played a role here. They also saw a notable increase in net gains from the sale of loans, which is a good sign that their loan origination and selling strategies are working. On the expense side, non-interest expense did increase by about 5.5% year over year. Salaries and benefits are up, which is understandable with overall growth and inflation. Technology expenses also climbed, possibly due to investments in their systems. What stands out is the mention of unification expenses related to a July 2025 system conversion. While these are expected costs, they did contribute to the overall increase in expenses for the quarter. However, their efficiency ratio actually improved, meaning they are generating more income relative to their expenses, which is always a good thing. Now let's talk about asset quality, because that is crucial for any bank. The good news is that their non-performing loans have significantly decreased to just $6.3 million, which is only about 0.18% of their total loans. That is a really strong number. Even better, non-performing assets as a percentage of total assets have dropped to 0.15%. This indicates they are doing a good job managing the quality of their loan portfolio. The allowance for credit losses is holding steady at around 0.99% of loans outstanding, which seems reasonable given the current economic landscape. Diving deeper into their loan segments, commercial and commercial real estate loans make up about 28.5% of their portfolio. They're focused on their regional markets with limited exposure to major metropolitan areas and office properties, which is a sensible strategy. Consumer loans, mostly auto loans, represent about 31.7% and surprisingly decreased slightly, likely due to inflation and higher interest rates impacting demand. Residential real estate loans, the largest chunk at almost 40%, saw solid growth. They're sticking to conservative underwriting for these loans, which is smart. Back to funding deposits are strong with total deposits reaching $4.1 billion. They saw a significant jump in interest-bearing checking accounts and other time deposits. What is interesting is the surge in municipal deposits up by over 19%. This seasonal influx is typical, but the overall increase is noteworthy. They also mention using reciprocal deposits to manage uninsured deposit balances effectively. Looking at the allowance for credit losses tables, we see that while the overall allowance amount is steady, the provision for credit losses has increased significantly year over year, especially for the 9-month period. This could be a proactive measure in anticipation of tougher economic times or reflect specific loan issues. The report mentions a notable charge related to a commercial real estate loan participation that has since been reclassified. This is a good reminder that even with strong overall asset quality, individual loan issues can arise. From a capital perspective, A.R.O.W appears very strong. Their common equity tier 1 capital ratio is well above the regulatory minimums, indicating a solid financial foundation, and their bank actually exceeds those minimums too. They are consistently exceeding all required capital ratios, which is a big green flag. They've also been actively repurchasing shares, which can be a good sign if management believes the stock is undervalued. So what is the story here? A.R.O.W Financial Corporation seems to be navigating the current economic environment quite well. They've managed to grow their net interest income by earning more and paying less on their funds, which is a classic sign of sound financial management. Their loan quality remains a strong suit with non-performing assets at a low. However, the increase in the provision for credit losses and unification expenses are points to watch. The company is also proactively adapting to interest rate changes using derivatives to manage risk. Strategically, they seem to be focusing on their core community banking while prudently managing their investment and loan portfolios. The unification of their former subsidiary banks into a single entity is a major step they are taking to streamline operations, and it seems to be going as planned though, with some associated costs. In conclusion, A.R.O.W Financial Corporation is showing resilience and strategic adaptability. They are financially sound with strong capital and improving profitability metrics. The key risks to monitor will be the impact of potential economic downturns on their loan portfolio, the effectiveness of their cost management strategies, particularly with the recent unification, and of course the ever-present interest rate volatility. Overall though, it appears they are steering the ship effectively. Alright, that is our deep dive into A.R.O.W Financial Corporation's latest filing. What are your thoughts on their performance and their strategy for the future? Let us know in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more of these corporate expeditions. And remember to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next one.